Inflation data was released this morning. CPI came in at 5.4%, in line with June's numbers. However, core inflation came in lower than expected. We're going to be talking about this with Todd Bubba Horwitz of BubbaTrading.com. Welcome back, Bubba.
David, it's great to be back with you. Always a pleasure to be on Kitco with you.
Always a pleasure to have you, Todd. Now, inflation, headline inflation, 5.4%. It's the same as the previous months, but it's still the highest number since 2008. So, how do you feel?
Well, I mean, listen, the number one, the Fed will not admit that there's real inflation, and they continue with this transitory, temporary. I think you might hear some news out of Jackson Hole, but what they're really telling you is that they're willing to run their legalized Ponzi scheme even longer, because at the end of the day, rates should be rising here. That's what the bond markets are trying to tell you. That's what every market is telling you. But the Fed stands pat, trying to keep rates low, which is artificially making the wealthy much wealthier.
Okay, but do you think that inflation has peaked? Do you think that 5.4% is as high as it's going to get, because it's 2 months now in a row?
I think it's getting it a lot higher. I think we're in real trouble because of the policies of the administration that's in power, and of course the Federal Reserve. This is something that you and I have talked about many times in the past. The Fed has never been right in their history with trying to handle this policy here, and they're going to be proven once again. I think we have a chance for hyperinflation, and I think you'll see much higher inflation going forward unless they step up and be counted and allow these rates to be normalized and let them be where they should be, which is probably 4 or 5%.
Well, so that okay, we'll talk about that. But when you say hyperinflation, Todd, what does that mean? Double-digit inflation for you?
Very possible. You've got the potential for stagflation because of employment. You've got the possibility for hyperinflation, which is in the double digits. There is a lot of bad things that are happening, all because of the policies that we follow and giving up the true free market price discovery model of the important asset classes, which rates being one of them.
Okay. We're seeing certain components of the CPI, like used cars and trucks, for example. They're still going up, but according to the reading here, it's only gained just 0.2% in July after climbing 10% the prior month. So certain components that have climbed the most in previous months are starting to falter in terms of growth and prices.
I think you might have an inventory problem there, which is why you're seeing some of the sectors go lower. The car industry has a inventory problem now. You can't find used cars now. There's a supply demand becomes a part of this whole equation, and you had so much buying, and you had so many people out there that the inventory is lesser right now, and of course that can also be account for the numbers. The real problem is that energy numbers remain high, although gold, crude oil has sold off recently. But overall, the numbers are way too high and artificially pushed higher because of what we've done with our oil here. And again, they don't count food and energy when it comes to inflation data. They always exclude it, and that's another issue because the biggest expense we all have is food and energy.
Okay, so when you say that yields are going to go to 5 to 6%, that's after hyperinflation sets in, Todd?
Well, I think they should be at 4 or 5 or 6% now. Okay, that's the point. That's what I'm trying to say is if you go around and you look at people that are borrowing money, normal people, middle class people, they're not getting 2.5% as the very extremely wealthy get to borrow at. They're paying more. And if you go to some of the peer-to-peer lenders, they're paying as much as 8, 9, and 10%. Look, go ask the farming community what they're paying for money. It's a lot more than what you see on TV and the 2 or 3% they talk about. And this is the problem because rates themselves should be higher. So we're being artificially fueled by these lower rates.
The discussion I've had with several economists is whether or not the nation can afford yields at 5, 6%, even 4%. At $30 trillion of national debt right now, even 5% would imply an interest expense annually of around $3 trillion. That's a lot of money.
Well, of course it is.
Actually, no, sorry. That was a mistake. I meant $1.5 trillion. But yeah, even then, that's a lot of money. That's like half our tax revenues.
which goes back to my original comment that it's a Ponzi scheme. Whose fault is it that the debt is so high? We continue with this ridiculous stimulus without people working, all with the target and the aim of trying to get the universal income. So that when you artificially, and then you continue to print money and borrow money and don't follow any sort of a budget and keep going for these $3.5 trillion infrastructure package, which what percentage is going to go actually to the infrastructure? Probably very little. When you continue to bail out states and you continue to do all these things and you have no budget, no way to manage the money, what do you think is going to happen? So that's not our fault as citizens that the government is out of control with their spending. I can't help the fact that they want to spend so much money, okay, but they're creating the problem by doing so.
So, okay, let's talk about the infrastructure bill then. It was passed in the Senate earlier this week. Do you think Biden is right in saying that it will not increase inflation, spending $1.2 trillion?
No, I think Biden is wrong. I think Biden is clueless about just about anything you can ask him about and doesn't really have a handle on what's going on. He's just kind of the intermediary standing there and getting pushed around by his underlings. Again, I don't think that he's really on top of it, and I don't think he really understands what's going on here, which, again, the willingness to continue to spend, especially on stimulus packages when there are so many jobs available, it makes absolutely no sense what they're doing.
I think I knew your answer before I even asked you, but I just wanted to double check, Todd. So, all right. So the infrastructure bill is possibly going to exacerbate inflation. Well, what is it going to do to create new jobs like the politicians have promised? What is it going to do to stimulate growth, to make the nation grow faster, put the nation back on the right track? Do you think it has any positive effects whatsoever?
It could, if it is done properly. It could have a lot of positive effects, David. But again, remember, this is not just this administration. This is going back administration after administration, both sides of the aisle. They continue with the false promises, but don't deliver. If they did it the way it should be, which is a total rebuild of America and the bridges, roads, and everything out, levees, then you would create growth and jobs. But the real question is, will you get people to go back to work to take these jobs? We have right now a surplus of jobs that are paying much more than they paid just 6 months ago. And still people don't want to go to work because they have the stimulus check keeping them from working. So that there's a problem in the whole system and the way it is set up.
That's a good point, yeah. If you take a look at the job openings that the data from the St. Louis Fed, we'll show this chart to the audience, job openings have spiked up recently. It's at, temporary record highs. And I've done some quick number crunching of my own. If you take the number of unemployed plus the people outside of the labor force who want to work, you take that number subtracted by the job openings, you're still that number has come way down, meaning that the labor market has begun to tighten. However, it's still not as tight as pre-COVID levels. In other words, the unemployment rate is still higher than pre-COVID levels. So people are talking about a labor shortage. Todd, I'm wondering why there's a labor shortage, because I just explained, the unemployment rate is still.
Check to stay home, and I don't have to go to work. I can make the same money sitting home doing nothing. Okay, you got McDonald's paying $16, $17 an hour now. You got companies offering $500 bonuses just to come to work. Okay, so if you continue to fuel this artificial move with stimulus packages that allows people not to go back to work, you're going to have troubles everywhere. I mean, you go any service restaurant or any service company or business, they don't have enough help because people don't have to work because they're getting that stimulus check. This is the whole ball rolling downhill, which is only creating bigger problems and higher debt, which should have been eliminated. We've got a clear bill of health other than the variants, but wearing masks, you've got people that can work, you've got people going out, you've got packed airports, but yet we have no help because, of course, the government's paying them to stay home.
So what do you think is going to happen once the stimulus checks end eventually? Do you think
first of all, I really believe that they're going to this administration is going to try to push for universal income. So I don't know that it's going to end so fast. But when it does end, it's going to create a major rush on jobs. And of course, then the employers will take back advantage and lower the amount of money they're willing to pay. Right now, they're willing to pay a lot more than scale of what should be paid, but they can't get help, so they have to keep raising the bid. It's it's another price discovery market, and I think you're seeing this play out. And as long as people stay away, the rate of going to work will get higher and higher and higher until they get people.
Todd, let me just show you this chart here. This is from the Atlanta Fed. This is their wage growth tracker. As you can see now, in the last, since the start of the year, really, it's kept trending down. Why is it that we have a labor shortage in certain sectors, yet supposedly wages have not spiked up? That seems odd to me. Can you offer
again, I don't know how much credence I put into the chart that I'm looking at, because I know what people are paying. Okay, I also know that we continue to see major stimulus. So when you have those two combinations, the companies are paying a lot more money. That is a fact. That's not fiction. But I think the chart what we're looking at is a little bit outdated and probably not actually currently up to date, because wages are much higher now than they were 6 months ago. And they continue to rise on a daily basis as companies scramble to get people to work.
Which sectors have you observed in which wages have risen?
The service industry can't get any help, basically. Any of the fast food restaurants, hotels, they are starving for employees and willing to pay them 30 to 40 to 50% that they would have paid them pre-COVID. And they don't want to go to work because, again,
they still don't. Wow.
Look at you look back. It always goes back to the free money that they're receiving. They don't want to go to work, because why should they, when you've got a package that is paying you equal or similar to what you would make if you went to work?
Okay, so let's just, I know you said that UBI is a potential likely outcome, but what happens if, let's say, the stimulus checks end, people go back to work? What would happen to wages then? Will it continue to rise, or would the bid kind of slow down a little bit?
I would think that they would probably normalize back towards the lower side once the demand for jobs returns. Remember, if you're running a service industry, you have to have help to take care of your customers. And, so right now they're willing to pay just about anything. Now, if they get an over influx of labor, then suddenly they're going to start to normalize or bring back down what the pay is going to be, because then people are going to be desperate to go to work. This is why the masses that are staying home because of stimulus are making a mistake, because they could be locking in much higher wages now and be set versus waiting because they're well over the minimum wage. So there's a lot of room to come down.
Do you think that these wages, these wage growths that you've observed, have anything to do with this higher inflation number that we've seen in the last couple of months?
I think it's got a lot to do with it. I mean, you go to McDonald's, for example, and you used to be able to go to McDonald's and for under $10 you could feed 3 people. Now it's about $15 or $16. I think everywhere you go, you are paying more dollars and more money, including gas, and everything else that you do is more expensive today than it was. And this is only going to get worse, because you've seen what has happened to some of the raw commodities like orange juice, coffee, and other things like that, which are exploding higher. Okay. The only good sign right now is that lumber costs have dropped dramatically. But other than that, we've got everything points higher.
So the labor shortage and wage growth have both contributed partly to higher inflation, is what you're saying. So then, if wages normalize down the line, should they normalize, should it not stand to reason that inflation could be brought back to under control? Is that possible?
It certainly could be brought back to control. But again, remember, we're just looking at parts of the equation, and it does not mean that prices that you are paying today are going to come down. One thing we know, other than the oil companies who kind of go up and down at the pumps, Starbucks is not coming back down, and you can bet there's a price increase coming at places like that. Once these guys get that extra profit, they're not such in a hurry to drop it down. They continue to make the profit. So I don't know that we're going to see such a significant drop in inflation, because we've still got too many underlying factors. Number one being the way interest rates are right now, which is really creating a much higher. I mean, we've got record debt right now, revolving and short-term debt.
I've had this discussion with my friend. Every single restaurant that I've visited in the last year or so, there haven't been many during COVID, but I've gone out since lockdowns ended. Every single restaurant I visited have raised their price by not like a few dollars, but like a large percentage from last year's menu. If you were a business owner, Todd, if you were a restaurant owner, would you decrease your prices next year? Would you lower your prices back to pre-COVID levels if, let's say, everything returns to normal, everyone's going out, and all of a sudden you've got more competition now? Let's say your supply chain's normalized. Let's say it doesn't cost you an arm and a leg to ship your fish anymore. Would you lower your prices?
Well, I think that what you've got here now, David, is you've got the restaurants are packed right now. Mm-hmm. Okay. Everywhere I've been is packed. Okay. I think the smart operators will bring their prices back down, but it will have to correlate to what they are actually paying. Remember, energy costs are so much higher now that it costs more to get the goods to your store. So even if your cost of goods come down, you still have a very high expense to get them to you. So there's a lot of factors that will play out in this whole deal. But I would suspect that the good restaurants, the good places that you go, they're very reputable and bigger, will be happy to lower their prices based if their costs come down. They're not, they don't work on a high profit margin to begin with. So their costs have to come down before they're going to come down. But I would suspect that you would start to see some of the bigger places come down should their costs and everything else come down.
Okay, let's talk about the markets now. Gold reacted to the news. It went up $14. I'm looking at the screen right now. You would expect gold to, react positively to inflation. So how is the gold market reading it? I mean, the inflation number, as I said, the inflation number is not hotter than last month. It's still pretty hot, but it's not anything higher than what we've already seen. So why did gold go up today?
Gold is pretty weak, okay, in here. After that flash crash Sunday night, Monday morning,
sure.
It's been a week ahead of that. But you've got a metal that's the metals are just very weak right now. And there's not a rhyme or reason. They go into these cycles, and right now they're in a net bear cycle, working their way lower. And, at some point we will turn around. And I still think buying physical gold and physical silver and physical platinum are ways to play right now. But I do believe that they're probably still headed south. I mean, this is not a very good rally as you look at the last couple of days. And, again, they read into these numbers long before they get posted on the news.
If you think interest rates are going to go up, does that not mean that gold would suffer as a result?
It could. But remember, gold markets pre-price in a lot of information ahead of time as we go forward. The gold market may very well be telling you, along with the bond market, that they're getting fed up with these ridiculously low rates. And you could see that maybe the selling's already been there before the rates start to go up. And that is always the issue now. Information flows so fast that many people are pre-pricing in things before they hit the news tape because they can actually do that with all the information that's out there. So again, I would look for gold to continue in its downtrend right now. Certainly long-term, 2, 3, 4 years from now, I would expect it to be significantly higher than it is today.
And what about the stock market, Todd? I'm looking at the stock market indices. They've climbed a little bit today on the news that inflation came in at 5.4%. Can this run continue for much longer?
Listen, it keeps going up. It's going to go up until it doesn't, David. Again, cheap money, the ever-ending chase for yield, or as they call it now, TINA, there is no alternative. Where are you going to go? So if you want to earn yield on your money in a liquid asset, it has to be in the stock market, which will lead to a major collapse. But when is it going to be, right? Nobody knows when that's going to be. We've been through this cycle before, and it will happen again, like it always does, and it will catch the most amount of people at the time. But right now, you still have too many negative people looking for it to go down, which means that will help continue to fuel it higher. Add that into low interest rates, no place else to go. The market should go higher, and at some point it will collapse, but it's not collapsing today or tomorrow.
Okay, makes sense. All right, well, Todd, thank you so much for your update today. Appreciate it.
David, thank you so much. Appreciate being with you.
And thank you for watching Kitco News. Don't forget to follow us on Twitter at DavidLin_TV and subscribe to our YouTube channel.